Okay, get ready, because we're about to unlock some knowledge that could totally change how you see the market. Forget slow growth. We're talking about high growth giants, the kind that could power your portfolio to absolutely new heights. This is insane. You won't believe what we're about to unpack. Stick around. You're with ChannelVest at last.
This is your analysis. Welcome to the deep dive, where we take a stack of information and really extract the most important nuggets for you. Today, we're diving into the world of multi-bagger stocks, those high-growth companies that could potentially deliver explosive returns.
And just quickly, it's critical to understand that the insights we're about to share are for educational purposes only. Really important. This is not personalized investment advice. You should always, always consult a licensed financial advisor before making any investment decisions. Our analysis combines AI-powered data mining, comprehensive web research, and expert market analysis. But please know, while we believe all data is accurate as of publication, we assume no liability for errors or investment losses. And as always, past performance does not guarantee future results. You know the drill. Right. So with that essential context in mind, our mission today is to cut through the noise and show you exactly what makes these top 10 potential growth stories so compelling. And hey, if you're looking for more insights like this, make sure you're subscribed and have notifications turned on. You don't want to miss out. So how do you even begin to identify these multi-bagger opportunities? It's not just a dartboard throw, right?
Definitely not. Exactly. There's a rigorous methodology behind it. We look at 5 key criteria, each of the specific weighting to ensure a balanced assessment.
Okay, lay it out for us. What are we talking about?
First up is growth potential, and that's a big one, 30% weighting. This looks at revenue growth rate, sure, but also the overall size of the addressable market, like how big can this company get?
Yeah.
And how strong is its competitive position, its moat? It's really about identifying companies with genuinely expanding markets and, real competitive advantages.
Got it. Big market, strong position. What's next?
Then comes financial health, weighted at 25%. Here we analyze cash flow generation. Are they actually making money? Also, debt levels, are they manageable? And profitability trends. This ensures sustainability, protects against downside risk.
Makes sense. Can't grow if you're drowning in debt. What about what the market thinks?
That's analyst sentiment. 20% of the score. What do the pros say? This includes looking at their price targets, any changes in recommendations, buy, sell, hold, and estimate revisions for earnings. It helps validate the investment thesis with sort of the market consensus.
Right, seeing if others agree. So that's growth, health, sentiment. What else?
Market momentum, that's 15%. We look at technical indicators, institutional ownership, like are the big funds buying in, and insider activity. It gives us a pulse on market trends and, honestly, can help with figuring out entry timing.
Okay, interesting. And the last piece?
The final 10% is dividend quality, but only for companies that actually pay dividends. We assess yield sustainability, payout growth history, have they been increasing it, and coverage ratios. Can they afford to keep paying?
Wow. What's fascinating here is how these criteria work together. It's not just about raw growth, but also about stability and market validation, even timing. Really comprehensive. Okay, so we know how they picked them, but what's the overall environment these companies are operating in? What are the big economic forces at play?
Yeah, the big picture context is key. If we connect this, 2 major drivers really stand out for the U.S. market right now. First, the Federal Reserve's monetary policy. It continues to influence growth stock valuations, no doubt. Interest rates remain elevated, but they've been pretty stable, which actually kind of supports dividend-paying stocks while also maintaining an appetite for growth investments. It's an interesting balance.
And the second driver, the one everyone's buzzing about.
AI infrastructure spending.
Yeah.
Absolutely massive. It's driving unprecedented capital allocation across tech sectors. It's just everywhere.
And that leads directly into the sector growth catalysts, right?
Yeah. Precisely. We're seeing over $200 billion in global AI infrastructure spending projected for 2025. That's huge. Plus, the cloud computing market is still growing at an impressive 15–20% annually. There's surging demand for semiconductors because of AI chip requirements, and digital transformation is accelerating across enterprises. It's a really powerful combination.
All right, this is where it gets really interesting. You won't believe the names on this list. After all that methodology and macro analysis, who are the chosen few?
Okay, drum roll. We're talking about some truly dominant players here. The Master League table reveals the top 10 potential multi-bagger stocks for 2025, ranked by their overall score.
In the top of the list. Don't keep us waiting.
All right. Number 1, Palantir Technologies, PLTR. 2, NVIDIA, NVDA. 3, Meta Platforms, Meta. 4, Microsoft, MSFT. 5, Tesla, TSLA. 6, Amazon, AMZN. 7, Alphabet, GOGL. 8, Advanced Micro. Well, the first thing is the significant outperformance compared to the S&P 500 median for these top performers. It's not just small gains. Many are showing truly remarkable year-to-date returns. It really underscores the potential here.
So these are the big players, many of them tech giants. But with great excitement often comes, well, high valuations. What does the valuation picture tell us? Are they getting too pricey?
That's the million-dollar question, isn't it? The data clearly shows a correlation between those high growth rates and, higher valuation multiples. AI-focused companies especially are commanding premium valuations. You see some pretty eye-watering PE ratios.
Does that mean they're all stretched thin, like too risky?
Not entirely. Technology stocks like Palantir, NVIDIA, and Tesla, yes, they show the highest growth expectations, but also the most stretched valuations. That definitely requires careful position sizing, don't bet the farm. However, value opportunities do exist. Look at Meta and Alphabet. They offer strong growth potential, but at more reasonable multiples compared to some sector peers. And then Realty Income, provides that portfolio diversification with its steady dividend yield of 5.7% to help balance the higher risk growth positions. This is insane, the range you see.
That's a crucial insight. It's not just about chasing the highest growth number, but finding that balance, right? Between growth, value, and even defense. Okay, let's unpack these one by one, starting with the top two. AI powerhouses. Palantir Technologies, PLTR. Current price, $149.07. Market cap, 337 Bs. YTD return, a massive plus 98%. But that PE ratio, 648x. Wow. Revenue growth was 39% year over year in Q1 2025, with U.S. commercial revenue exceeding a $1 run rate. Pretty impressive numbers.
Yeah, the bull case for Palantir is strong. Its market-leading position in enterprise AI, plus those high switching costs, create a really strong competitive moat. Customers get locked in. But the bear case is that valuation. It's extremely high, implying huge future growth, and there's still a significant dependence on government contracts, which can be lumpy.
Okay. Next, NVIDIA Corporation, NVDA. Current price, $130. Market cap, $2.7 trillion. YTD return plus 20%, PE ratio of 65x. Data center revenue now makes up 88% of their total revenue, and gross margins are over 70%. That's huge.
For NVIDIA, the bull case is just this incredible acceleration in AI infrastructure demand. Everyone needs their chips, and there's strong adoption of the new Blackwell architecture. Bear case, again, extreme valuation multiples, even at 65x for that size, and potential competition down the road for custom chips developed by their own customers. You won't believe how fast this sector is moving.
Next up, two tech titans you definitely know making big moves in AI. Meta Platforms, Meta. Price $713.72, market cap $1.2T, YTD return plus 24%, PE ratio 27x, and now a small 0.5% dividend.
Right, the bull case for Meta is all about those AI-driven advertising improvements. They're getting smarter, making more money. Plus, strong user engagement metrics drove 15% revenue growth in Q1. UBS even raised its price target to $812, citing that AI monetization potential. Meta has been like 2025's standout tech performer so far. The bear case involves the regulatory overhang, antitrust, privacy concerns, and those high AI infrastructure costs could pressure margins, even with efficiency gains.
And Microsoft Corporation, MSFT, price $503.35, market cap $3.08, YTD return plus 21%, PE ratio 38x, dividend 0.7%.
Microsoft's bull case. Azure Cloud revenue grew 33% in Q3 2025. That's huge. And AI services contributed 16 percentage points to that growth. Melius Research raised their target to $595. It's all about cloud and AI integration. The bear case. Again, high valuation metrics relative to history and increasing competitive pressure in cloud, especially from specialized AI providers maybe nipping at their heels.
From electric vehicles to the everything store, these next two are always pushing boundaries. Tesla Inc., TSLA. Price $332.19, market cap $800, YTD return an amazing plus 90%, PE ratio 120x, no dividend, price target $350. That 90% surge in June 2025 was something else.
The bull case for Tesla is leadership in autonomous driving. Their FSD technology is really showing significant progress in the expansion of their energy business. Those are growth vectors beyond just selling cars. The bear case. Still those high valuation multiples for what's fundamentally a car company, plus increasing EV competition from, well, everyone, traditional automakers and new players.
And Amazon.com, Inc., AMZN, price $227.40, market cap $2.14, YTD return plus 15%, PE ratio 37x, no dividend, price target $254.
Amazon's bull case. AWS
AWS market leadership continues, plus that rapidly growing high-margin advertising business is a huge plus. AWS revenue grew 17%, strong AI workload adoption there too. Morgan Stanley raised their target to $300. The bear case involves pressure on e-commerce margins, shipping, labor costs, and that intensifying cloud competition, mainly from Microsoft and Google.
Diving into two more crucial tech players now. Alphabet Inc., GOGL. Price $192.11, market cap $2.50, YTD return just plus 1%, P/E ratio 25x, no dividend, price target 201 revenue, up 12% to $90.2 billion.
Okay, the bull case for Alphabet is still that search market dominance. It's just massive. Plus, the acceleration in their cloud business, Google Cloud revenue grew 28% to $12.3 billion in Q1. They're gaining ground. The bear case. Regulatory challenges, they seem never-ending. And the potential for AI to disrupt its core search business model. That's the big existential question for them.
And advanced micro devices, AMD price $154.72, market cap 250 buys, YTD return plus 25%, PE ratio 45x, no dividend, price target $165, stock up 25%, YTD is pretty solid.
Andy's bull case. New AI accelerator product launches hitting the market, and they're definitely gaining data center market share from Intel. Analysts see Q2 revenue between $7.7 billion, so momentum looks good. The bear case is mostly about NVIDIA competition and AI chips. NVIDIA is just dominant there, and the usual cyclical semiconductor market challenges. It can be a roller coaster.
Our final two companies showcase a fascinating contrast. A high-flying pure-play AI company and a stable dividend pair. This is quite the pair. First, SoundHound AI, SOUN. Price $13.19, market cap just $4, YTD return an absolutely insane, plus 190%, PE ratio NA because they're not profitable yet, no dividend, price target $12. That stock exploded 190% over 12 months.
Yeah, the bull case for SoundHound is its leadership in voice AI, especially in cars and restaurants, a strong partnership pipeline, and that high-growth recurring revenue model. Q1 revenue grew 151% year over year to $29.1 million with a $1.2 billion booking backlog. This is insane. The growth is just off the charts. But the bear case is significant. Not yet profitable, very high stock volatility, and, competition from the tech giants who could decide to enter their space more aggressively.
You won't believe the difference in profiles between those two.
And finally, Realty Income Corp. Price $51.50, market cap 45 Aussies, YTD return plus 8%, PE ratio 58x, dividend a hefty 5.7%, price target $75.
Realty Income's bull case is consistency. Monthly dividend payments, a defensive tenant mix in drugstores, convenience stores, and it's an S&P dividend aristocrat. Super reliable. Plus, it trades at a 23% discount to its estimated fair value of $75. The bear case. Sensitivity to interest rates, higher rates make its yield less attractive comparatively, and just the general retail real estate challenges in an evolving market.
Okay, this has been an incredibly exciting deep dive into potential growth, but we have to talk risks. What are the risks we need to be aware of? What could derail this?
Absolutely raises an important question. What challenges could these companies or the broader market face? The risk assessment highlights that an AI bubble burst, basically the hype cools off, and a general market correction represent the highest combined probability and impact risks. Those are the big ones to watch.
So what happens if things get bumpy? Do we have any idea how these might hold up?
We do. Stress test scenarios show potential stock performance under adverse conditions, like a 20% market correction or a sudden 200 basis point interest rate hike. And this is exactly where those defensive positions like Realty Income, really provide important downside protection. They can cushion the blow.
So after all that incredible detail, all the numbers, the bull and bear cases, what are the absolute key insights for you to carry forward? The big takeaways.
Okay, summing it up. 1, AI revolution driving returns. Tech stocks leveraging AI are delivering exceptional returns. Palantir and NVIDIA are prime examples. 2, diversification remains critical. Yes, growth stocks offer multi-bagger potential, but including defensive dividend assets like Realty Income provides crucial portfolio stability. Don't put all your eggs in one basket. 3, valuation vigilance required. Many top performers trade at premium valuations. This needs careful entry timing and position management. Be mindful of the price you pay. 4, long-term perspective essential. Multi-bagger returns typically require holding for 3 to 5 years, riding out the market cycles and volatility. It's not usually an overnight thing. And 5, risk management paramount. High-growth investing demands proper position sizing, diversification, and a systematic approach to capture that upside while managing the inevitable downside risks.
This information is gold, seriously. But how do you, listening right now, apply it, whether you're just starting out or a seasoned investor?
Great question. For beginners, I'd say focus on the diversified AI leaders like NVIDIA, Microsoft, maybe Palantir. Start with maybe a 20-30% allocation to these types of growth stocks to reduce concentration risk. Use dollar cost averaging over 3 to 6, investing fixed amounts regularly to manage volatility. And plan to hold positions for at least a year for potential long-term capital gains benefits. Using tax-advantaged accounts like IRAs is also smart for high-growth stuff. Now, for pros or more experienced investors, you could consider smaller AI pure plays like SoundHound AI, but alongside those dividend growth stalwarts for balance. Maybe use covered call strategies on large positions to generate extra yield. Definitely monitor quarterly earnings dates and guidance changes closely. Those are key catalysts. And think about tax loss harvesting opportunities against your winners. Crucially, maintain cash reserves so you can buy into high-conviction positions during market corrections. Stick around for those opportunities.
So as you look at these potential multi-baggers for 2025, ask yourself this. In a world driven by accelerating AI and digital transformation, where do you see the next unexpected surge coming from? Maybe even beyond these top 10. Something to think about.